Joining us now is Adam Button, Chief Currency Strategist at Forex Live. Thanks for making time, Adam.
Hi, Jackie.
So can we start with the euro and just a bit about the sort of forces at play here? You know, how much of it comes down to the ECB raising rates, but, you know, now they're just above zero, at 75 basis points in positive territory in terms of their rates there. How much of it does it come down to that?
Right. So the ECB, generally when a central bank hikes rates and is hawkish, you see a positive response in the currency. The market is a little more concerned on the growth side in Europe right now. They're so far behind the curve on inflation, and they're facing such a crisis with energy that the market's looking and saying, listen, I can still get much higher rates in the US or Canada or a number of other countries, less economic risk, and there's far less government debt to worry about in a lot of these places, or less problematic debt. So it hasn't had that natural response because it was undoubtedly more hawkish than the market was looking for today. And I think we saw a little bit of that yesterday from Canada as well with the Bank of Canada. So, you know, the dynamics are really shifting in the currency market where investors are looking for growth. And, you know, there are some big risks out there, especially in Europe.
Yeah, I mean, the energy crunch that they're facing has the potential to be quite severe, and the impact that would have on the economy. I mean, the ECB cutting forecasts for growth, but still, you know, expecting growth. So, you know, what are your thoughts on what the sort of future holds for the euro with that in mind?
Yeah, the ECB forecast for next year, I think, is plus 0.7% GDP growth. And the most market participants are looking at that and shaking their heads because most are expecting a recession. However, I will say that this week we've had some very positive news. The German finance minister or economy minister came out 2 days ago and said, listen, a lot of businesses are going to have to close. And the market, I think, they're recoiled at that and said, hey, wait a second. And now we saw a distinct shift in tone today where he said, we're going to cast a wide umbrella for small and medium-sized businesses at least. And earlier this week, we heard in the UK saying, you know what, we're going to bail out everyone. We're capping energy bills at £2,500 a year. And we're going to have supports for businesses as well. And this is very reminiscent of the COVID response, where it was slow at first. We worried about mass bankruptcies, businesses closing. And then the government came in and took on all the risk on its balance sheet and said, you know what, there are going to be losses, but it's going to be in government debt. And I think we're turning that corner right now in Europe and in the UK, and that could put a line under those currencies, but especially under those equity markets.
And you mentioned the Bank of Canada as well and its recent decision. What do you make of the Canadian dollar and what's happening there? Because we've been seeing it trade around this 76 cents US level for about a week now, but, you know, seeing weakness against the US dollar this year down. We're looking at the I think this is the Bloomberg Dollar Spot Index, but down to over 3% so far over the past year.
Yeah, you know what, the Canadian dollar has been hit with a lot of bad news. You know, we've seen a distinct slowdown in the housing market. The global economy is slowing. The commodity markets have turned. But the Canadian dollar has held up all right. And some of that is the Bank of Canada. It was much more hawkish yesterday than we thought it would be, or that the market thought it would be. I think a lot of people thought there'd be a top around 3.5%. From the Bank of Canada, from 3.25% now. I think it's easy to see that getting up to 4 or even 4.5%. In the next day or so, I expect a lot of economists to roll out with notes saying, you know what, we're going to predict a higher terminal top. And some of that's going into the Canadian dollar now. We've seen a little bit of strength this afternoon. The Bank of Canada was also quite a beat on the Canadian consumer and business investment. That might be a little bit misplaced as these interest rates hit and mortgages reset. And people feel the higher cost of that, and businesses feel higher borrowing costs. I think that might be a little bit premature, but the bravado is there from the Bank of Canada for a reason, because they want the market to clamp down on those short-term inflation expectations and to keep a lid on that. But I think as we get closer to that 4%, maybe around the turn of the year, they might start to soften that stance. So for now, though, it is good news for the Canadian dollar.
It's interesting today, too, the senior deputy governor, Carolyn Rogers, was asked about the currency, and she said normally rates would go up and the price of oil would go up. You would see some investment coming into Canada, and you would see the Canadian dollar tick up. And that would provide an important buffer on inflation. And she says we haven't had that buffer. What do you make of that sort of disconnect happening there?
Well, it's really a tragedy. In any other environment, Canada, the oil patch, natural gas, commodities in general would see surge in investment coming into this country. But it's just been such a difficult place to invest. And until we see concrete action, and we saw that in the UK this week, we had a new government, a new prime minister. Really, one of the first things she said is, we're open for fracking now. We're opening up the fields. And I think to get the market's attention and the international investors' attention, you need to make some sort of show of making this a place to invest. And right now, the oil sands still aren't seen as that, even though there are compelling reasons to invest in Canadian oil and in particularly in gas right now. So maybe we need to see a sustained period of $100 oil or even higher prices, and some changes for other commodities as well for that to happen. I think that's inevitable because we do need more of the things that Canada has to sell. But the timing of it's not right now, and it's uncertain when that will be.
We've also been looking a lot at the U.S. dollar lately because of the run that it has been on, trading, near 20-year highs, at this point. What are your expectations for the U.S. dollar?
We've seen, it's interesting this week because we had two major speeches in the U.S. Powell, again today, did the Jackson Hole speech, very hawkish, very simple, unambiguous. And he's had to send this kind of message because the Fed was really upset with the way markets responded in July when it was more nuanced and meme stocks took off again. And it was silly season again there for a little while. And he's reeled that back in. But the other speech this week was from Vice Chair Brainerd, and I think that gets to the heart of the real Fed stance. It was much more nuanced. It had a lot of those transitory talking points, reasons inflation might come back down. She also said there's a risk of over-tightening. And that, I think, is where the Fed stands. And we saw equities with a pretty strong rally on that yesterday and the dollar come off. And I think in time it's going to be clear that that's the real Fed stance. Again, we've got this bravado from the Fed, and that'll probably continue for the next 2 weeks, at least through their decision at the end of the month. And then I think eventually they'll start a slow pivot on that. And within the next 3 or 4 months, we're going to see a top in the dollar.